we have had the FOMC, and they've been telling us what they are currently looking for. If we look at their monetary policy statement that they published 4 minutes ago, they say that all available suggested the indicators suggest that all available indicators suggest that economic activity has been expanding at a solid pace. I've been saying that the US economy is quite great. It's quite solid. Job gains has remained low, and unemployment rate has been little changed in recent months. Inflation remains somewhat elevated. Isn't that great? Isn't that great to hear that what you have been saying for quite a while is actually they also agree upon? We haven't seen a lot of push on the dollar because of it. Slightly lower on the candle. I was expecting this one to be a bullish event. More importantly, because I was expecting them to increase their forecasts, their inflation, their GDP, PCE inflation forecast. So I'm happy. I'm positively surprised. So for all of those of you who are here today, happy to back. I'll try. I'll try to get back. So my first little question is, do you want us to go live in New York session or in London session? Or third question would be when I'm taking trades. So that would be great. But what I was looking for before all of this, what happened in the Middle East today was to be dollar bearish. Given that we were going to have a fantastic reopening of the Strait of Hormuz, we are going to go oil lower. We're going to be great. Trump is the greatest president that's ever existed. He brings peace to the world. Magnificent. So if that would be the case, then it would be great to uh, to have the call it to have the war intervention something gone. We also have another problem. We have dollar yen currently at 159. When we were here last time over the weekend, Bank of Japan and South Korea came out and said, hey, we don't like the current forex volatility. They didn't say may intervene, but yeah, that is literally the level that they have been discussing. So if today would be a dollar bullish situation, that is definitely something to look out for on the yen pairs. That's why I haven't traded yen this week, even though I wanted to. I was like, I want to. But if we were going to get slammed with a 500 pips fall, it doesn't really suit my trading style to hit stop losses every day. So I decided that the risk was too much for me, but yeah. Whatever I'm talking about today is only my personal opinion, not financial advice whatsoever. Trading forex and financial markets is risky. You should not trade the money you cannot afford to lose, and 90% of traders lose 90% of the money in 90 days. There you go. So projections for first year is 3.1, second year 3.1, current 3.4, and 3.1 longer. Okay, so yeah, okay, it's not the worst, I guess. But I would be very curious to what it does to the what it does to the current levels, where we have already seen in the past week, or in the past week for that matter, we have priced in less and less interest rate cuts or federal funds rate cuts in 2026, and that seems to be continuing and going forward. So when all of that is out of the way, I was thinking, wow, shouldn't I buy, like, I don't know, again? um, and I was thinking, well, why not central pivot? That would be a great place to look for a buy. And what we are looking for today is basically their inflation expectations, what we have seen, and then we are in 20 minutes going to hear. And I think that if they go for a more, the risk is too uncertain at the moment, or the the risk is too uncertain right now, like RBA did yesterday, like Bank of Canada did earlier today. If they do the same, and even Bank of Canada has, and didn't announce per se that they're going to rate hike, but they say that this Middle Eastern tension is going to increase inflation, but also increase costs in the economy, but also increase income, because they are income generating when it comes to oil. But yeah, so that's kind of where I'm laying my sword when it comes to Powell. Where is he going, or where does he feel that inflation or this is going to go? Is it going to be, for them, what I would call complete, not lame, but like paralysis? They're not doing anything. They're like, oh, we don't know what's going to happen. That is definitely dollar bullish. So for me, thinking dollar bearish, I don't really want to see that kind of language, and yeah, and that kind of a language, and that kind of a thing. What kind of assets do you guys want me to look through? Is there anything specific before I go through everything you don't care about? Is there an asset that you do care about? High innovations. From, if I correctly remember. But yeah. Are we gold? Is that where we are today? Then I was supposed to have a little link, but too late, too sorry. Okay, I need to disable view. Okay. Anywhere to server. Thank you very much. Free Discord. Sorry. Discords even. A lot of them. It's only one, two. Sorry. In message. So, first of all, I am happily pleased that dollar hasn't strengthened yet. I am pleased that gold hasn't fallen that much. So to me, my little gold theory here is gold is going to fall, dollar is going to be bullish for as long as we have the war. And I'm more on the fence of, I'm waiting for them to be done with it. And there seems to be unfinished business, and I don't like what I saw today. Where did they take out the deputy? Oh, what was the person I call again? some high-ranking Iranian official that was confirmed deceased. Then Israel had attacked an oil field in Iran, or Iranian oil field, which else actually UAE condemned. It's unnecessary. I felt like we were in a position where we are gonna get this done and over. Though the Trump administration has said, it's going to be another few weeks, whatever that means. And normally when they say it's just going to be a few weeks, it actually means in the next few days, because they can't say it's going to be tomorrow. But I mean, to me, I am all for as far as it can fall, even if it's $3,000 an ounce, as long as it returns higher when we are done with these things. It's been our good evening. How are you? So to me, gold is wherever it falls down to, and we're probably going to be quite a V reversal on most assets going back higher. Whenever there is an announcement, so it's more to me like, am I online? Am I asleep? Am I awake when that happens? And then the next day take the pullback. First, my plan is to buy whatever the price is whenever I see it, and then look for the pullback the next day and the next day and the next day. Kind of like what happened. Was it April 6th or something in that direction? April 6, 7, 9. So 9th, where Trump announced that he was going to revert back on the tariffs, and then we have pullbacks in the following few days, and then it turned higher. So for me, it's important to be in whatever the price is and stop below where the bottom is going to be. We are seeing a bit of a red candle now, and I think that's very much natural in the current situation that we are in. Though we haven't at all priced in the implication of the Middle East tension into the US stock market, with what it could potentially do. So to me, we're still very much elevated, if that is the word we want to use today. So yeah, okay, now a bit of slightly more bullishness on dollar. So what I'm looking for, I mentioned that slightly previously, but what I'm looking for today is dollar strength and a potential intervention from Bank of Japan / South Korea. So what I am looking for in other screens is if there is a bank that reports that either Reserve Bank of New York or the Bank of Japan calls them and asks for the opposite, meaning if it's the Bank of Japan, they ask for the dollar rate. If it's America, they ask for the yen rate. They call it trading desks. And what then happens is that is the last thing they would do before actual intervention. That generally scares the market. So that could lead to yen strength, because we are at a level, and if we now start to go, not supersonic, but if we start to go above this price, so intervention levels for me has been 160 and above, and we are now 159.39. They started talking here quite seriously. They were quite, I read it as quite seriously, so that is literally verbal intervention. Hasn't done any whatsoever damage to the trend or anything. So what is next then? Well, that is rate check. What is next then? Actual intervention. And what they normally do is they intervene in, they sell their US bonds and then buys yen currency. That's generally the trade-off they do. Or convert it back, sorry. But yeah, convert it back to yen. So yen strengthens. And what they have done before, they have spent 35 billion they spent in 2024? something in that direction. So bajillion the money. So it's not going to be a push; it's going to be a waterfall, because market right now is quite liquid. What do you think about oil? My honest opinion here is that we are going to still we are going to stay above 90, or elevated, as Powell would say. We're going to stay above 90, and normally 67, 60. We're going to stay above 90 as long as we have the straight close. We again today did not see any improvements. So yeah, and until then, it's kind of like over here. Until then, we just have to wait. What is kind of the problem is, the good thing is that the EIA has released reserves. So there is oil in the market, people are not going without oil and petrol. But there has been, was it 6 countries who has started to close down in ration, which was Thailand, Vietnam, Bangladesh, Sri Lanka, another country, and where you basically have to either not use the car every day or not reuse what do you call it? Not use air conditioning so much and use shorts and t-shirt and stay at home every Wednesday. So there's already been that, and that leads to major economies. The other thing why we are here is China is getting oil out of Russia and out of Iran somehow, somewhere, some way. So we are okay as long as China doesn't fall over. We are okay. So in the current situation, it's bullish. But that doesn't mean that we are trending now. It's just going to be 19 above. If you're paid money to hold oil contracts, then sure, that is probably the way to go. But if it costs you money to hold the contract, I would wait until we start to see scarcity, and when this reserve starts to dry up, and seen we haven't seen any change in the Iran Hormuz Strait opening. Even if it opens, it would take a month for them to get back online, and then it take another month, at least for Japan, to get shipment to Far East Asia. So it's a 3-month kind of get back to normal. And most countries, some countries doesn't even have reserves. Japan has 3 months, so we are now 2 weeks in. So 2 weeks from now, they should be done with it. If not, we are in for, I don't know, the price going higher, but high. Then we are also fragile to Trump saying, "Hey, war's over." Then the market is going to collapse on itself. So it's a very risky situation. Good evening. What do you think about the direction of the stock market for the next few weeks? I am positively optimistic. That means that I see that we haven't really priced in the current situation in Iran or Middle East or the oil price. Um, Inflation going higher is good or so, or up to a certain point for the stock market, if it leads to higher interest rates. So the difference between when inflation starts rising, that's normally good for businesses, until Fed increases the interest rate, that little gap, that benefits the stock market. So I'm optimistic that that's where the route is going to be. Of course, that also leads to, or depends, that we are getting we ending the situation in the Middle East, and then it's straight up. Until then, range. And I'm as good as you as to estimate of when Trump is going to call it off. He says a couple of weeks. I don't know. And the market doesn't know. And until then, we can range, go slightly lower until it picks back up again. Australia has already reported that they're starting to see increased inflation. We're just 2 weeks in, so it's going to come fast. So that little window between increased inflation and and the Fed increasing interest rates might not be that much. So if that's a month different or in the next meeting or something, I don't know, but probably. If it goes too fast, too high, too quickly, then we're going to have a meeting in between, like we did in 2020. Let's turn off my vibration. Thank you very much. You're very much welcome. Hi, Toby. How are you today? Are you a job? Toby, good job. So that is kind of my perception, and then Nikkei has fallen and is in this kind of range, and then DAX 40 is kind of in the same not necessarily depressed, but short-term lower, I would argue. But of course, if this leads into another Gulf War, or if this leads into what happens in the 70s and 80s, then we are just in for. It's just at the beginning of everything. And again, also FTSE in the UK, and 100 cash is also relatively lower. I feel my opinion is that it's just temporarily. I don't know what I made this, but I mean, if I sold it, could have made some money there. I didn't. I don't know what this is. This is just drawings. This is not a physical actual trade, but I mean, I'm good at it. But I didn't put an actual trade on it. I would rather. I don't know if it ever happens, but something like this. This is what I'm looking for. But I'm more than anything else looking for the signal that the war is over. Then you have Cuba. Cuba is, what was it the other day? 10 million people without electricity. That is definitely a case where Trump can move his attention to, like that. And there is a theory in my life that says that, hey, there is a theory in my life that says, hey, that you, there's a theory in my life that says that somebody else is trying to hold this war going a bit longer than it needs to. So I believe Trump is a great person, that he is wants to end it as fast as possible so that we don't suffer too much. If you're wondering, I'm trying to get into America at some point. I don't want to be stopped at the border being like, hey, you said this on YouTube. Yeah. Sorry, mate. Because people have been stopped. Well, one person was stopped with a funny picture of JD Vance on his phone, Norwegian, but it was something else he was also stopped for. But I think it was D-related. But it's quite funny if that's what's going to stop me. But yeah, so my little theory here is I don't want this euro-dollar to fall. We're going to have Mr. Powell speak, and let them take the word, I guess, and then we will go from there. I am dollar bearish in the theory and in the world where we are going to have an end to the war. So so it's not really an aggressive theory that I have. I see this is a double bottom. That is the number one. This could be the number two trade for that matter. So that's why I'm like, okay, this is actually a trade that I should be in. But I really also want to be a bit more certain. But then if Trump is not as aggressively bearish or sorry, not as aggressively bullish, then we might have a dollar bearish reaction to it, and that's what I kind of That's what I really want to see. So we'll see. We'll see what he says. Can't what do you call it? Can't say before it happens what is going to happen. But that's my hopes. And then that could turn gold around higher. That could turn your dollar yen lower. We saw euro yen coming a bit higher earlier today, pound yen as well, New Zealand yen. And then I'm looking for an Australian dollar CAD bullish trade because Australia has gotten a lot of inflation, and CAD with a falling oil when that happens is kind of my go-to. Like it's going to be an instant. Like that's my plan automatically, instantly when I see the news, if I get to be alive and awake when that happens. I guess that's not necessarily always going to be the truth. Cool. Haven't seen. There we go.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy has been expanding at a solid pace. While job gains have remained low, the unemployment rate has been little changed in recent months, and inflation remains somewhat elevated. Today, the FOMC decided to leave our policy rate unchanged. We see the current stance of monetary policy as appropriate to promote progress toward our maximum employment and 2% inflation goals. The implications of developments in the Middle East for the U.S. economy are uncertain. We will remain attentive to risks to both sides of our dual mandate. And I'll have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. In our summary of economic projections, the median participant projects that real GDP will rise 2.4% this year and 2.3% next year, somewhat stronger than projected in December. In the labor market, the unemployment rate was 4.4% in February and has changed little since late last summer. Job gains have remained low. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including job openings, layoffs, hiring, and nominal wage growth, generally show little change in recent months. In our SEP, the median projection of the unemployment rate is 4.4% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.8% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. Near-term measures of inflation expectations have risen in recent weeks, likely reflecting the substantial rise in oil prices caused by the supply disruptions in the Middle East. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 2.7% and 2.2% next year, a bit higher than projected in December. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5 to 3.75%. From last September through December, we lowered our policy rate 0.75 percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should continue to help stabilize the labor market while allowing inflation to resume its downward trend toward 2%. But the implications of events in the Middle East for the U.S. economy are uncertain. In the near term, higher energy prices will push up overall inflation, but it is too soon to know the scope and duration of the potential effects on the economy. We will continue to monitor the risks to both sides of our mandate. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of this year and 3.1% at the end of next year, unchanged from December. As is always the case, these individual forecasts are subject to uncertainty, and they are not a committee plan or decision. Monetary policy is not on a preset course, and we'll make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you, and I look forward to your questions.
Thank you. Colby Smith of the New York Times. There's been some debate about whether the Fed should look through the inflation that will come from higher oil prices stemming from the Middle East conflict. Is that the right approach at this juncture? And to what extent does the fact that inflation has been above target for roughly 5 years now influence the committee's thinking around this?
So, first, let me say we're well aware of the performance of inflation over the last few years and how a series of shocks have interrupted progress that we've made over time, and that happened most recently with tariffs, and now there will be some effects on inflation coming forward. The thing that's really important that we see this year is progress on inflation through a reduction in goods inflation as the one-time effects on prices of tariffs go through the system, go through the economy. That's the main thing we're looking for going into this exercise. And we need to be seeing that to sort of understand that we actually are making progress, because on net we didn't make progress. And if you look at total core inflation, it's about 3%, and some big chunk of that, between 1/2 and 3/4, is actually tariffs. So we're looking for progress on that. The question of whether we look through the energy inflation doesn't really arise until we have kind of checked that box. It, of course, is kind of standard learning that you look through energy shocks, but that's always been dependent on inflation expectations remaining well anchored. And I think now it's also dependent on what you mentioned, which is that broader context of 5 years now of inflation above target. We have to keep all of those things in mind, and the question of looking through when it does arise will be one to approach not lightly, but in the context that you mentioned.
And just on the SEP, can you help us make sense of why there is still a bias to cut for most officials this year, despite the upward revision to headline and core inflation and the essentially unchanged forecast for growth and unemployment? I'm just curious, kind of what's the genesis behind the need? What's the need for the cut?
Yeah, so there are 19 people, and so 19 reasons, 19 individual submissions, and if you notice, the median didn't change, but there was actually some movement toward a meaningful amount of movement toward fewer cuts by people. So 4 or 5 people went from 2 to 1, let's say, 2 cuts to 1 cut. And each person has individual, stories behind what they want to do. But essentially, it is that the forecast is that we will be making progress on inflation. Not as much as we had hoped, but some progress on inflation. It should come as we start to see in the middle of the year progress on tariffs. Going through once and then tariff inflation coming down. We should be seeing that. And the rate forecast is conditional on the performance of the economy. So if we don't see that progress, then you won't see the rate cut.
Howard.
Thank you. Howard Schneider with Reuters. Just to follow up a little bit and to be clear, is the higher inflation penciled in here for 2026 solely the result of the oil shock or something else?
So that's going to be part of it. But, that wouldn't be most of core, right? So the oil shock for sure shows up here. Some of that will be in core as well. But yes, but no, there's also just the feeling that we haven't seen, the progress that we had hoped for on core goods. And on tariffs and on the rest of it. So for whatever reason, people did write up their inflation forecast. That will certainly be tied to events in the Middle East and the price of oil, but it's also, I think, a reflection of the slow progress we've seen on tariffs, which we believe we will see. It's just a question of how long it takes for them to get all the way through the economy, and it just takes some time.
Right. And is the lack of change in the SEPs, again, just to explicate this a little bit, more due to the expectation that the oil portion of this will pass through, or more out of concern that there is a potential blow to consumption and growth coming in the form of wealth effects with the stock market down, in the form of gas prices, diverting spending from other parts of the economy?
So I didn't get the second part of your question.
That consumers are going to be potentially diverting money to gasoline from other parts of the economy. There could be a growth shock or a redistribution of spending there that can hit consumption, wealth effects as well. I guess I'm wondering, is the rate forecast not changing because you think the oil shock is going to be temporary, or because you want to be sure you're positioned in case growth starts to slow?
So the thing I really want to emphasize is that nobody knows. The economics effect could be bigger, they could be smaller, they could be much smaller or much bigger. We just don't know. So people are writing down something that seems to make sense to them, but have no conviction. To your point, if we have if we have a long period of much higher gas prices, that's going to weigh on consumption. That'll weigh on disposable personal income, and it'll weigh on consumption. But we don't know if that's going to happen. Something quite different than that. We might have much lower than expected pass-through. So people write down, this is one of those SEPs where a number of people mentioned if we were ever going to skip an SEP, this would be a good one, because we just don't know. So I wouldn't say there's a conviction that this is going to go through quickly or not quickly. It's just you got to write something down, and this is something that is that people wrote down. We don't debate how long. How do you do that? We wouldn't be able to debate what the length of or size of these effects would be. We just have to kind of make an individual statement. And also, what you've written down before you'll be reluctant to move too far away from that, just because you don't know. It's so unclear what the direction from this particular end will be. Meanwhile, the growth has been solid, and inflation, the overshoot is mainly from the goods and tariffs. And, the labor market is, the unemployment rate, of course, is little changed since September. You have a very, very low break-even rate, apparently, for new jobs, with little growth in either demand or supply. But the U.S. economy is doing pretty well. It's just we don't know what the effects of this will be, and really no one does.
Steve.
Mr. Chair, in the past, the staff has suggested that higher oil prices, they have a hit to consumption, which Howard was talking about, but that's somewhat offset by increases to domestic production. I wonder if you could talk about that dynamic, especially to the extent that how much U.S. production is happening right now.
So the first thing is there is, the original thinking, the long-standing thinking, put it that way, is that you do look through energy shocks. But as I mentioned, that's conditioned on inflation expectations and that kind of thing. So, sorry, your question was?
What the staff is saying about, and has said in the past
Yeah.
about
So there'll be an offset.
offsets, yeah.
So that's true. You know, we have, we're a net exporter of energy, right? So any effects on employment and economic activity and spending would be offset to some extent by the fact that our oil companies will be more profitable and they may even do more drilling. If you ask oil companies about doing more drilling, though, they're going to want to see, you know, a consistent rise in oil prices from where they were before the buildup for the war, and they're going to want to believe that that's going to be persistent for a fairly long time. So they're not sitting there waiting for oil to go over $70 a barrel, and then they're going to start drilling or whatever. They're going to make a reasoned, careful judgment that we're going to have higher oil prices for an extended period, meaningfully higher. So I wouldn't say there's much of that happening. Not much will be happening now, but some of that could happen over time if you see that. But so the net of the oil shock will still be some downward pressure on spending and employment and upward pressure on inflation, of course.
And if I could just follow up on Colby's question, how much do you worry that having looked through tariff inflation and inflation running above target and looking through the oil price shock would undermine the credibility of your commitment to the 2% target?
You know, we have to do our analysis and you know, think these things through carefully, but of course that's on everyone's mind. You know, we're well aware of the history, and but you don't want to overreact to that. You know, you want to make the best judgment you can based on the facts. I don't think we're going to let it color our decision making more than is appropriate. It's more the thought that it's been 5 years, and we've actually had, you know, we had the tariff shock, we had the pandemic, and now we have an energy shock of some size and duration. We don't know what that's going to be, actually. And, you know, it's one of those things where it's a repeated set of things, and you worry that that's the kind of thing that can, you know, can cause trouble for inflation expectations. And so we worry a lot about that, and we are very strongly committed to doing what it takes to keep inflation expectations anchored at 2%. And, you know, I think it's important that we do that. Very important.
Nick.
Nick Timmeros, The Wall Street Journal. Chair Powell, you've described monetary policy as modestly restrictive. If the unemployment rate is roughly stable, inflation moving sideways in the high twos, with an ongoing overshoot in services and non-housing services, not just goods, and the economy doing fairly well, as you just outlined, what gives you confidence that inflation returns to target over the next couple of years?
Okay. So I would say the rate is, you can characterize it as in the high end of neutral, or you can characterize it as perhaps mildly restrictive, even modestly restrictive. No one knows for sure, but it's in that range where it's somewhere around the borderline between restrictive and not. Remember that a big part of the disinflation we're looking for is just the runoff of when tariffs are put into place. Of course, what they do is they raise prices to some extent, to the extent those prices the tariffs are paid by consumers, on a one-time basis. And we're waiting for that process. It takes 8, 9, 10, 11 months, a year to go through the system. And we're waiting for the tariffs, which were put in place over the course of the middle part and later last year. We're waiting for that to go through the system so that goods inflation will return closer to what it's always been. I mean, it used to be, for many, many years, it was negative. And then, you know, the year before tariffs came in, it was 0. And it's running at like 2% now. So, and so that's kind of, goods inflation is running at 2%. So that's not coming from standard Phillips curve restrictive, restrictive policy. It's coming from the runoff of a one-time thing. We also think it's important, though, to keep policy either mildly restrictive or, you know, close to that, but not too restrictive because of the weakness in the downside risk in the labor market. We are balancing these two goals in a situation where the risks to the labor market are to the downside, which would call for lower rates, and the risks to inflation are to the upside, which would call for higher rates, or not cutting anyway. So we're in a difficult situation, and we feel like our framework calls on us to balance the risks, and we feel like where we are now, which is kind of on that borderline, the higher borderline of restrictive versus not restrictive. We feel like that's the right place to be.
Can I ask about core non-housing services, though? Because there are some people who think that it hasn't come down very much, if at all, over the past year. If wage growth has come down, if the labor market has loosened, why has non-housing services inflation maybe been slower to follow?
That's a good question. It's frustrating. Non-housing services they basically moved sideways for a year. They're at the same level, and we do expect that they will come down. But it's a bunch of idiosyncratic things. But at the same time, that is one of the things we should be seeing, because to your point, the labor market is clearly not a source of inflationary pressures, and that should really matter for non-housing services, but we're not seeing progress there. So we do, what we expect for next year is what we want to see for this year, rather, is continued progress on housing services, finally seeing that, the goods inflation come back down because the one-time effects of tariffs are through, and then also get some help from non-housing services. That's what we'd like to see. But it's a good question why we didn't see much of that last year.
Edward.
Thanks, Chair Powell. Edward Lawrence with Fox Business. So in December, we saw employment numbers revised down to negative 17,000. January revised down. February posted a loss of 92,000. Is the employment side a far greater risk than the inflation side? Because we are seeing inflation, CPI is close to 2%. PCE has ticked down overall.
It's really, I wouldn't say that. I wouldn't say that that's clear at all, that one is more at risk than the other. So you can point to the unemployment rate being stable, and, in a world where both supply and demand for workers have come down very, very sharply over the course of the past year due to immigration policy largely, a ratio is going to be a better thing to look at than job creation, for example. So, and the ratio is the unemployment rate, and it's been stable since September. So that tells you that. Inflation, you can. We're at 3.0% core. Inflation 2.8% headline. So we've been well above the 2%, that amount, whatever it is, 0.7, 0.8, or a full percentage point above 2% for some time. And that's a concern. We need to get back down to 2%, and we need to keep focused on that, even though we do now face some new inflation from energy. So I'd be hard-pressed to say that one of them is obviously more at risk than the other.
And if I may, what happens if there's no Federal Reserve chairman confirmed on May 15th? Would you stay on?
So if my successor is not confirmed by the end of my term as chair, I would serve as chair pro tem until he is confirmed. That is what the law calls for. That's what we've done on several occasions, including involving me, and it's what we're going to do in this situation. And while I'm at it, on the question whether I will leave while the investigation is ongoing, I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality. And I would refer you to the statement that was in the Fed's brief that you all have seen, and I won't have anything more for you on that. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet, and I will make that decision based on what I think is best for the institution and for the people we serve. Figuring you probably were going to set the dominoes off there, Edward. And I'm not going to have any more to say on those issues, by the way.
Thank you very much. Claire Jones from the Financial Times. People have drawn quite a few historical parallels with the current situation. We've seen oil price shocks in the past. Some people have said the first Gulf War and the Fed's response to that, where there was a focus on the growth risks, is the right parallel. To what extent would you agree with that, and to what extent do you think we're in a different place today? Thank you.
It's really hard to say until we see the situation, the actual situation. In some circumstances, that might be the right case. In fact, for example, if we do see the kinds of disinflationary progress that we expect to see due to tariffs that I mentioned, I think it's hard to say, and it will depend to some extent on the size and duration of the effects we're seeing on prices, and it will depend a lot on what we can see in inflation expectations.
And just one follow-up, if I may, just on the BLS report that was mentioned briefly there. It doesn't seem from the projections or from the comments you've made today about the unemployment rate and focusing on that, that your view on the labour market story, to a large part being a supply side story, has changed despite the quite negative number in February. Would that be the right take, and was there anyone else in the room who thought differently and that the February jobs report was cause for concern?
So I think you have to take the two together. You know, in a way, the January report was a positive surprise, and the February report was a negative surprise. If you put them together, you get something in the middle, and I think you have to really, as you do, I'm sure, realize there was a strike and there was weather, and that's about 80,000 of the negative effect total on the February report. Notwithstanding that, so what do you see if you take a step back overall? There are a number of indicators that suggest a degree of stability, but the thing that I think a good number of people on the committee are concerned about is just the very, very low level of job creation. If you adjust what has been the trend job creation over the past, let's say, 6 months, if you adjust that for what we think, our staff thinks, is the overstatement due to overcounting, effectively there's zero net job creation in the private sector. But actually that looks like that's about what the economy needs in terms of dealing with very, very low, non-existent really, growth in the labor force, which of course we've never had in our history. So you've got a sort of a zero employment growth equilibrium. Now that's balance, okay, but you know, I would say it does have a feel of downside risk, and it's not kind of a really comfortable balance. So you know, we look at that, we see it, we get it, and I mean everybody understands the arithmetic, and that's you can say the break even is zero, but nonetheless it's something we're watching carefully, and so and you know, are concerned about. But ultimately though, you can argue that it's a consequence of deliberate policy, which is really the changes to immigration. That's the biggest factor there, and but nonetheless something we watch carefully.
Andrew.
Thanks, Chair Powell. The economy's experienced a series of supply shocks in the last few years, COVID, tariffs, 2 oil price shocks. Do you think that is bad luck, or has something changed in the world that makes supply shocks more common, and does the central bank need to start taking account of the risk of supply shocks as a more common problem?
You know, we did go through a long period where the shocks were all demand shocks, and you know, so we've had a lot of practice thinking about supply shocks in the last 4 or 5 years for sure. And it's just a very different thing, and a very much more difficult thing, because it does immediately raise the question of tension between the two parts of our mandate. But you know, has the world changed? I mean, COVID is a one-time thing, right? This energy supply shock is a one-time thing. It's not because of some broad tendency or anything, I don't think. And you know, the oil shock with Ukraine was also a consequence of military action. So I don't know that the world has changed in a way that there'll be more supply shocks. But you know, people have written that paper and that speech a number of times. A number of people have tried to make the case that is the case. And in fact, we have seen more supply shocks in the last 5 years than we've seen in many years before that. It's a fact.
Okay. You said last year that the Fed was reviewing its communication strategies, including the SEP, as part of its framework review. Whatever happened to that? And I have like 5 follow-ups to that, but you know, I guess, you know, what would you change about Fed communications if you had the time? Thanks.
What happened about that was not much, and I'll tell you why. So, you know, we looked carefully at many aspects of the SEP and of our communications, and there weren't any ideas that had very broad support on the committee. And you don't want to make a change to your communications unless you have the committee behind that. So we didn't really make any changes on that. I had hoped that they had some things that I wanted to do, but they didn't attract broad support, and we'd already made all the changes we made to the framework. That was a critical thing. So we didn't. And, I wish we had been able to do some things, but we didn't. So maybe the next chair will take a look. I'm sure he will.
Michael McKee from Bloomberg Television and Radio. The minutes show in January some members of the committee wanted to include a two-sided guidance on policy. Was that discussed today? And given the rise in the inflation expectations, how much support for a two-sided policy warning would there be?
So it did come up today. The policy that the possibility, rather, that our next move might be an increase did come up at the meeting, as it did at the last meeting. The vast majority of participants don't see that as their base case, and of course we don't take things off the table. But you correctly characterized, what was in the minutes that several participants indicated, and something very much like that conversation did happen. What was your second question, though?
I was just one question there, but follow-up would be, there are a lot of goods besides oil that are trapped in the Strait right now, and a lot of supply chains getting snarled. How much concern do you have about whether, if this becomes an inflation problem beyond just oil, whether there's anything you can do about it or would do about it, given the efficacies of monetary policy?
You can worry about other commodities. You can worry about all of the ways that oil-related commodities go into manufacturing and that kind of thing. The truth is, it's completely out of our hands, and we just, like everybody else, we have to just wait and see what happens, and it'll come down to how long the current situation lasts, and then what are the effects on prices, and then how do consumers react and that kind of thing. Really, I wouldn't speculate in any way, and there's really not a lot we can do other than kind of watch and see.
Maria Luisa.
Afternoon, Chair Powell. Maria Luisa Capurro with Bloomberg News. I wanted to ask you, you've said longer-term measures of inflation expectations reflect confidence that the Fed will get back to its 2% goal, but there are some colleagues of yours who have pointed to higher dispersion in household service, in business services as well, so, and that they take as a signal that inflation expectations may be less sticky than in the past. I'm wondering if there was a discussion around that at this meeting across the committee, and what were the views of what is the state of inflation expectations and the risks from higher oil and gas prices.
So at this meeting, I mean, a number of people mentioned and staff briefed on short-term expectations having moved up quite a lot for reasons we understand well. But long-term expectations, you can always find one that's troubling or some aspect of one that's troubling, but ultimately, right through this whole period, the overwhelming majority of the things we look to, including markets, including surveys of the public and also of forecasters, they've all been pretty solid on longer-term inflation expectations being right where they need to be, consistent with 2%. So that continues to be the case. We didn't have a lot of conversation about that. I think everyone does agree that we'll be watching those extremely carefully as we see the effects of the price increases come through from the conflict.
And still on how the discussion went across the committee, before coming to this meeting, there were some members who were discussing the risks of a slowdown in growth at a time of where inflation remains high. It really doesn't seem that most members are penciling in a slowdown in growth.
No.
But has there been any discussion of the risks of stagflation at this point?
So people actually wrote up their growth forecast by a tenth, and I think that's probably to do with just growing confidence in productivity. But sorry, and your second question was just.
If there have been any discussions about the risk of stagflation scenario.
Yeah, so as I mentioned, there's tension between the two goals, right? The upward risk for inflation and downward risk for employment. So, and that puts us in a different situation. When we use the term stagflation, I always have to point out that was a 1970s term at a time when unemployment was in double figures and inflation was really high and the misery index was super high. Add them together, you get the misery index. And that's not the case right now. We actually have unemployment really close to longer run normal, and we have inflation that's 1 percentage point above that. So calling that stagflation, it's not. I would reserve the term stagflation for a much more serious set of circumstances. That is not the situation we're in. What we have is some tension between the goals, and we're trying to manage our way through it. It's a very difficult situation, but it's nothing like what they faced in the 1970s, and I reserve stagflation for that, the word for that period. Maybe that's just me.
Elizabeth.
Thanks so much. Elizabeth Schulze with ABC News. President Trump says that oil prices and overall inflation will go down very rapidly as soon as the war ends. Do you agree with that?
I don't have a forecast on that.
When we're thinking about the impact on American households, as you know, they've been facing these higher prices for years. They've seen an almost $1 increase in gas. How worried are you about households, especially lower income families, being able to afford those price hikes? And should people be bracing for higher costs, including for food now?
We don't know how big these effects are going to be, and I don't want to characterize them in any way. Of course, people are already seeing gas prices. Gas prices are up almost $1 a gallon. We hope that isn't for a long period of time, and of course people will feel that, but I don't want to speculate about what that might mean, because honestly that would sound like I have some idea of what's actually going to happen, and I don't think anybody really does. We're going to see how this works out, and I just would leave it at that.
Victoria.
Hi, Victoria Guido with Politico. I just wanted to ask, for purposes of the next meeting, how the Middle East war develops between now and then, how are you thinking about what might guide action at your next meeting? I mean, if we have oil prices, above $100 a barrel the entire time until the next meeting, is that going to change your wait and see stance? Like, what would lead you all to move, or are you on hold pretty indefinitely?
We'll have to wait and see. I mean, we always say we're going to learn more by the next meeting, and usually we do, but in this case we're going to learn a lot, because we're going to learn 6 weeks to the day till the next meeting, and we're going to see whether what happens is it's going to be very important for the way the economy looks and the way the outlook evolves with what happens in the Middle East. That's going to be a big factor, and we'll know that then. I don't know how it's going to affect our thinking. I really don't. And we did talk about alternative scenarios a little bit, but it's just, I wouldn't bring that in here. It's very uncertain, and I just want to remember that we don't know, and we shouldn't assume it's going to be one thing or another. We're going to see.
So is it a matter of you don't know how the situation itself is going to evolve, or even if things remain as they are, the economy could still remain relatively durable in face of them?
Yeah, that's true too. No, I mean, the U.S. economy has just, it's been strong through a whole bunch of challenges. I mean, if you go back to 2023, when we raised rates a lot in 22 and 23, and close to 100% of economists called for a recession, which didn't happen. In fact, 2023 was a really strong year. So the U.S. economy has really been just doing pretty well through a lot of significant challenges over the past few years. It's been amazing to see. And I don't know what's going to happen in the next intermeeting cycle, and I don't know what's going to happen in the Middle East. I wouldn't want to speculate.
Hi, Chair Powell. Thanks for taking our questions. What makes you so certain that tariff-related price increases will be a one-time effect? I don't think we've seen you since the Supreme Court tariff decision, and it's pretty clear that none of us know what the extent of the tariff shock will be as the administration moves to replace some of the tariffs that were overturned. So I suppose I'm curious, what would make you question this certainty that tariffs are going to be a one-time price effect?
Well, I would not at all use the word certain about my views on that. I'm not certain. I'm uncertain. But just if you think about what it is, it's a one-time increase in the price of a good, right? And what inflation is ongoing increases in prices this year, next year, the year after. That's what inflation is. It's not a one-time price increase. There's a very, very big difference. The public doesn't really focus on that, but that's the difference. And tariffs should be in theory, unless they cause people to start expecting still more tariffs the next year and still more tariffs the next year, they should be a classic one-time thing. People say the same thing traditionally about an energy price spike, because traditionally prices go up and they come back down. And by the time monetary policy would react, you would, it would be over. So I don't have tons of confidence on that. I mean, I think that the theory is probably right, but as usual, the time it takes to get all the way through the economy is just very uncertain. And we found that coming out of COVID, that the inflation did go away, and largely for the reasons we thought it would, but it took 2 years longer than we thought. And so I think we have to be humble about knowing how long it will take for tariffs to go all the way through the economy. And so what we've been doing is, our staff's been doing, it's very interesting. They started off with just an estimate because there wasn't a real history, and then they've built, based on the history that they're seeing of tariffs coming through into prices, they can now have an arc, and for all the tariffs they can say, well, so we have, I think, a slightly more confidence that we will see tariff inflation coming down, not prices, but you won't see further increases, and we should start seeing that more and more in the middle parts of the year. We do expect that. Now, you're also right, though, that the level of tariffs came down fairly meaningfully in the wake of the court decision. But the administration said they're going to get that rate right back up to where it was. So, and we assume that they'll do that over time. So that's how we think about it.
Thank you.
Chris Rugaber.
Hi, thank you. Chris Rugaber at Associated Press. You talked about the shortcomings of the SCP in this environment. I wanted to ask about, or throw in an additional thing, which is the fact that it's happening before transition. Is there still some value, perhaps, in the public knowing what other Fed officials are thinking, the ones who will stay on for the rest of the year and beyond? And does that even handicap your successor in any way? Well, just in terms of having a whole committee expressing its views, is that something that locks them in for the rest of the year?
No. We never. The SEP is never. People are more than happy to change their SEP dots. They're no way bound by them. It's your opinion at a moment in time, which can change based on events. Sometimes very quickly. So it never locks people in. People are more than happy to be proven wrong in either direction, and so I just think we do it. And I mentioned this was a time when it's very hard to do it. During the pandemic, we actually took one meeting off, I think, but we don't like to do that just because it's hard to do. We should just keep doing it. But I just would say for this one, though, I think it's even more than usual good to take the forecast with a grain of salt, because subject to just very high levels of uncertainty.
Brian.
Hi, Chair Powell. Brian Chung with NBC News. So you mentioned at the beginning of this conversation that you're well aware of the history of inflation running above target. It seems like that might be what's underpinning the affordability problem that we're hearing a lot about on Main Street. Are there any signs to you that that's impacting the psychology of the consumer, especially given that they're a big driver of overall economic activity?
I'm not sure what that's all about, but I'll tell you what I think and what we see in surveys, and that is, there were big price increases all around the world, by the way. Everywhere in countries like the United States had basically the same kind of thing. It was a global inflation coming out of the pandemic, and everywhere people are feeling like real wages have been going up in the United States now for 3 years, roughly. But people are not feeling good about it yet, and it will take some years of positive real earning gains for people to feel good again, we think. But you're right. But when you talk to people, they do feel squeezed, and there are areas where prices are still going up, like insurance. Various different kinds of insurance are getting more and more expensive, and that's just catching up really from inflationary pressures that take a while to get to into the price. So We take it very seriously. We don't dismiss it at all. It's a very real thing from the standpoint of what people are experiencing, and you know, what it does for us is, you know, makes us even more committed, if that's possible, to getting inflation back to 2% on a sustained basis.
How does the Fed's independence play into the ability to address affordability?
Well, independence is what allows us to do our jobs, and you know, stable prices is half of our mandate. It's one of our two mandates, maximum employment being the other. I mean, look at every advanced economy that looks anything like the United States anywhere in the world, in a market economy, in a democracy, and you'll see, you know, pretty much central bank independence that looks a lot like, in some cases, stronger than what we have. But it's critical that we have that so that we can do the things when we need to do them to preserve price stability. And it's an accepted standard practice, and I think has a lot of support, certainly in Congress, which is where our oversight is in Congress. And you see that among Democrats and Republicans in the House and the Senate.
Hi, Chair Powell. Richard Escobedo at CBS News. Thanks for doing this. Two questions. One, how high would oil prices and broader inflation have to go, and for how long, for the committee to consider hiking rates? And then secondly, diesel prices are rising faster than gas prices. How concerned are you that the increase in diesel might drive up food and goods prices and lead to broader inflation?
Yeah, I'm not going to give you an example or specific answer on the first question. You know, we're prepared to do what needs to be done, but I wouldn't want to hypothesize about what that might be. You know, in terms of diesel prices, so your question there is, are we concerned about it? I mean,
how concerned, and whether or not it will drive up, you know, the cost of food and other goods that really rely on it to
so
move
I think
across the country.
it's a more general concern than that. It's diesel prices, because that's transportation of food and things like that. There are just lots of ways that oil and derivatives of oil get into the production and transportation of many things. So, and those, there are big effects in headline inflation, but things like that leak into core as well. And the effects may not be as big, but they're quite real, and they're material. So we are aware of that, and we're watching it. But you know, we're right at the beginning of this, and we don't know how big we just don't know how big this will be and how long it lasts. You know, it may or may not be something that really makes a big imprint on the U.S. economy. We're just going to have to wait and see.
Thank you.
Archie, for the last question.
Thanks very much. Just to sort of stare into the future for a little bit, I was looking at the longer run bits of the SEP. I noticed that the growth estimate had been revised up a good chunk from 1.8 to 2, and the kind of long-term Fed funds rate as well. It'd be great just to hear, is that AI productivity or what's going on there exactly?
Yeah, well, I think it's just productivity. You know, we actually started seeing meaningfully higher productivity some years ago, 4 years ago, 5 years ago, and that's not because of, you know, generative AI. We won't know for years what it's really due to, but it could be due to the kind of things that people did during the pandemic to economize and somehow become more productive because there was an incredible labor shortage. But I think economic forecasters are very skeptical of periods of high productivity because they're so rare, and they're often revised away. And for many of us, I never thought I'd see this many years of really high productivity, and by the way, expect it to continue. And we haven't really started to see the effects of generative AI, and that should certainly contribute to that. So it's quite unusual, and it's this is the higher productivity is the thing that allows incomes to rise over time. And so it's a great thing. Was that your question?
Yeah, no, I was just curious what lay behind that. And just briefly on that as well, to finish up, you hear the argument a lot, this is a sort of disinflationary story, and if you believe that productivity thing, that should also weigh down inflation over time, maybe then kind of pull down where rates end up. Do you kind of agree with that line of thinking, or do you think that's not how you should think about where the rates
I think you have to be cautious about that, in particular if you're talking about AI, about generative AI. So remember, in the short term, what's happening is we're building data centers everywhere, and that's actually putting pressure on all kinds of goods and services that go into building these things. So that's actually probably pushing inflation up at the margin. In addition, it probably raises the neutral rate. So in the near term, you're not looking at something that would immediately call for lower rates or that would be lowering inflation. Over time, though, sure, it can be if it's expanding potential output, which is what higher productivity does, then it actually can be. But I think it's an empirical question because it's really is the demand growing faster or slower than the supply side. And I think we just don't know that answer ex ante going in. We'll just have to wait and see. Thank you very much.
Thank you very much, Sir Powell. So what is the aftermath? The bloodbath on the street. What is happening? We are seeing dollar coming in higher. Boom! We are right about that one. S&P didn't say it would lower, but of course that would be subsequent. I also talked about dollar yen coming in higher. Boom! And then what's going to happen overnight is that Bank of Japan is going to intervene. I don't know what thank you in Japanese is, but let's say that. So okay, they erased their inflation expectations. They said that the U.S. economy is solid, is doing great. He downplayed the bearishness of the NFP report, saying you need to see that together with January and February together, and then we averagely are not too bad off. And it was just due to short-term situations like weather and strikes. So all in all, U.S. economy is doing great. USA is doing great. That means euro dollar fell. That means that I'm not going to buy euro dollar anytime soon. Even though my theory and my heart is like, what if it goes above? What if it rises? We have ECB tomorrow, so that's always a turnaround on euro, isn't it? Fantastic times. So that's one side, and then we have the UK tomorrow. They're also going to turn around and come in and with their interest rate and their MP, I said MP in chat, that is monetary policy meeting and statement tomorrow. That's could turn these around. So I'm not going to say, hey, I'm not going to do anything, but it definitely dampens things. And then I see on the regular news, we are seeing more, we're seeing attacks today on oil fields and stuff. So it's not really a great dollar bearish day. But of course, the Iranian gas company said that the Pars oil field fire was put out and returns to normal. And then we have seen some. I also posted that there was something in Riyadh. So okay, so that is gold weakness or gold falling, dollar strength, rising in inflation for as long as we still have the conflict and we still have escalation or continues to not really try to fix it. So that puts me on the spot. Euro yen, Swiss yen, euro yen, pound yen, all came down lower a bit. If this was a regular day without the Bank of Japan saying they're going to intervene, it would be a great time to look for a buy overnight for tonight or tomorrow. So would it be like, oh, what if it comes down there or down here? That would be great. But since we are at 159.70/80, We intervened 23rd of January at 159.20. That's about 50 pips lower. They have previously let the price go all the way up to 161.80. So that's a good, is it 100 pips higher or something? 200 pips higher. That's still a part of the chance. What's the math? So for gold, and I mean, you still have a pretty good daily candle. What I would say is I would go into my targets. That would be weekly target already hit. That's a crisis, or crisis. That's an issue. Sellers should be out, and if you get quite I think what you are supposed to do is supposed to target 44,400, not financial advice, but generally when you are looking for a weekly target going into a monthly target, so that means also that you would like to see a pullback, first falling and then a pullback. So if you are in a short, not that I mean myself, but if you are in a short, I think you should be quite happy, shouldn't you? Quite content. So overnight, that should, I don't know the future, but I would be very happy if I was in a sell on gold and it would continue lower. So easy peasy lemon squeezy. Whatever your target is, and if you have already hit. So when I say weekly target has been hit, that means that sellers for this week are out. That doesn't mean that all of them get out. May just be some. But generally speaking, if it's not really a seller's market, we can just tap and then go back again. So that's the risk, that we can just tap into current market and then go back higher. Do I see that in this situation? No comment. So for tomorrow, need to see this euro dollar. Euro dollar came back up to a perfect sell on the weekly. Fantastic. Pound same. Aussie probably same. Dollar Swiss came lower. Dollar yen came lower. So it's I would argue that it's going to be quite a bullish day tomorrow, unless something happens. So continuation into the strengths and into bullish targets, but be careful about dollar yen. Right. Thank you very much, everyone, for joining in. If you have not joined the Discord, free, talk to me there. And if you want help from me, set up a 1 hour meeting with me, then you can go to Discord and talk to me or find the link. Because I really want you guys to be better traders. So that's why I'm here. So I hope that helped. Give you a good direction and give you some help, give you some hope. And then